What if you invested in everything Warren Buffett said not to?
All right, we all know Warren Buffett, right? The Oracle of Omaha. The man who made billions by investing in companies like Coca-Cola, Apple, and American Express. And he's built his reputation on a simple rule. Don't invest in things you don't understand and stick to what works long-term. But here's the thing. Buffett has a long list of things he's told people not to invest in. So today, we're going to flip the script and ask, what would happen if you ignored all of Buffett's advice and invested in everything he said not to? Would you end up broke? Or could you have actually made a ton of money? Let's find out. Buffett's first big no, cryptocurrency. Well, this is an obvious one. Warren Buffett has publicly trashed Bitcoin multiple times. He's called it a mirage and said it's not a currency and won't end well. He even once compared investing in crypto to investing in a rat poison squared. But what if you ignored Buffett's warnings and put your money in Bitcoin instead? Well, in 2017, Bitcoin was worth around $1,000 per coin. Fast forward to 2025, and Bitcoin peaked at an all-time high of nearly $122,000. A $1,000 investment back in 2017 would have turned into over $120,000. That's still a massive return. Sure, crypto is volatile, but ignoring Buffett here could have made you a ton of money, at least till today. Second, the tech stocks. Buffett has been very vocal about staying away from tech stocks he doesn't understand. Specifically, during the dot-com bubble of the late 90s, he warned people not to get caught up in internet companies that were overvalued, which he was mostly right about. But what if you went all in on tech stocks like Amazon and Google, companies he wasn't fond of early on? Sure, you'd need a lot of luck and skills to find these companies in their early days. But here we are talking about what-if scenarios. In 2000, Amazon's stock price was around $10 per share. Today, it's worth over $220 after 4 stock splits. And Google, which he also passed on, went public in 2004 at $85 per share. In 2025, it peaked at $207 per share after 2 stock splits. If you ignored Buffett's advice and invested heavily in those stocks instead, you could have seen at least 7,500% return. A $1,000 investment in Google back in 2000, that'd be worth over $75,000 today. 3. The classic no-no, airline stocks. Warren Buffett hates airline stocks. He said they're a terrible investment because of the low profit margins and the unpredictability of fuel prices. He sold off his airline holdings in 2020, citing the pandemic's impact. But let's be real, if you invested in airlines during the pandemic, you might have seen massive growth as things recovered. Take Delta Airlines. In April 2020, Delta was trading at $20 per share. Fast forward to today, and it's over $40 per share, almost a 100% return in just a few years. It's not the wild returns of Amazon, but it's still not bad for a sector Buffett completely avoided. The biggest no-no of them all, gold. Now, Warren Buffett hates gold. He said it's a terrible investment because, unlike businesses or real estate, gold doesn't produce anything. You can't cash flow from it. To him, gold is just a shiny rock that doesn't create value. But here's the twist. If you had bought gold in 2001, when it was about $250 per ounce, and held on to it until today, gold would be worth around $3,400 per ounce. That's almost 14 times your money. And it gets even crazier when you compare it to inflation. In 2001, the dollar had a lot more purchasing power than it does now. Gold, as a hedge against inflation, turned out to be a surprisingly solid investment in the last couple of decades. The takeaway. So, what's the conclusion here? Should you completely ignore Warren Buffett's advice and jump into things like crypto, tech stocks, gold, or even airlines? The answer is a bit of a mix. Sometimes ignoring Buffett's advice could lead to huge profits, especially in the short term. But that's the thing with short-term investing. It's riskier, more volatile, and harder to predict. Buffett's philosophy, which focuses on long-term investing in businesses that you understand and that generate consistent profits, is still a solid approach. But, as history has shown, sometimes stepping outside of those boundaries can still work in the right circumstances.